Hello and welcome to today's webinar on how procurement can prepare for the recent tariffs and perceived trade wars. I'm your host, Sean Wendell. Before I introduce our speakers, let's cover a few housekeeping topics. Today's webinar is being recorded. We'll email the link to you after the event so you can rewatch or share it with your colleagues. Look for that email in the next day or two. If you have a question during the presentation, type it into the chat box and we'll try to answer it at the end. If we're not able to get to your question, or if your question requires additional research for us to answer completely, we'll be sure to follow up with you via email. This quarter's update is going to focus on commodity prices and tariffs, which have been all over the news lately. At the end of our discussion, we'll also open up to questions that you may have. Here to help us better understand what's going on are lead analysts Braden Baisley and Torsten Edstem. In addition to typically spearheading our procurement macroeconomic updates, Braden specializes in banking, insurance, and other financial service markets. Torsten is focused on research reports that cover a variety of products and services, including software, transportation services, packaging products, oil and gas markets. So without further ado, let's get to the presentation. Braden, could you start us out by explaining to our audience, what commodities are and how they impact procurement?
Thanks, Sean. So when we talk about commodities, we're simply referring to the raw inputs that are used to produce different manufactured goods. So I think it's best to start with a discussion of metals, given that these are major inputs in a lot of the markets we cover, such as capital machinery. Unsurprisingly, aluminum and steel prices have been accelerating as tariffs have been enacted. As you can see in the table, year-over-year price growth for the past quarter has been considerably faster in 2018 compared to 2017, and we project these trends will continue as the effects of the trade war materialize over the coming months.
Just a clarification, there's been a lot of talk in the media that metal prices are rising, but is that the case for every metal?
No, not every metal's price has been rising. Actually, domestic copper prices have been declining at a faster rate compared to a year ago.
What's been causing the decline?
It largely stems from shrinking demand from China, which is the world's largest consumer of copper. So while things haven't been entirely rosy for metals in recent months, falling copper prices have at least provided some relief to producers.
Okay, gotcha. So, falling domestic copper prices aside, how can buyers hedge against rising metal prices?
So one thing buyers can do is lock in contracts now before prices climb further. You may recall that imports in the United States surged this past quarter as buyers attempted to front load their inventories to get ahead of price increases. And that same concept applies here. Another strategy includes shifting to substitute goods. So for example, instead of purchasing industrial furniture made of something like steel, you may want to consider alternatives made of materials like wood or plastic.
Okay, so metal prices are generally rising, and that covers a pretty big swath of manufactured products. Torsten, what about oil prices?
So oil prices are following similar trends to aluminum and steel. So like steel and aluminum prices, the price of crude oil has been trending upward recently. And this rise in price is the result of the consumption of oil outpacing production by about 300,000 barrels per day. And we can actually see that illustrated here in this chart, where the blue line, which represents consumption, is falling above the orange line for production. And as the supply of oil available has decreased, providers have had more leverage to raise prices. And we believe that this upward trend in oil prices is actually going to continue during the next 3 years, as consumption continues to outpace production. And according to our projections, oil prices are going to be climbing at an annualized rate of about 5% through 2021.
So I'm thinking that just like aluminum and steel, oil probably finds its way into a lot of manufactured goods. What's going to be the impact of oil price growth over the next 3 years?
The increase in oil prices is going to impact a variety of markets. Fuels that are refined from crude oil, such as gasoline and diesel, are, of course, going to increase in cost as oil prices climb. And likewise, markets that provide services reliant on fuel consumption are also expected to see price increases. So trucking markets, transportation, anything where there's a high fuel consumption. And finally, any manufactured goods that rely on oil feedstock as an input could also see price increases. So for instance, flexible packaging and plastic bags, which are both manufactured from plastic film. And of course, this plastic film requires oil to manufacture. So as oil prices go up, the cost of these finished goods is could be rising as well.
What strategies can buyers use to be proactive and prepare for rising oil prices?
So bouncing off of what Braden said, procurement professionals can use the same strategy to hedge against rising oil prices as they do with steel and aluminum prices. So here we're looking at primarily negotiating long-term contracts because by locking in prices at current levels, buyers can ensure that they continue paying a fixed price for oil-dependent products and services, even as those prices are trending upward.
Okay, so let's wrap up our discussion on commodities here. We have major inputs like oil, steel, and aluminum on the rise. Those cost increases are going to make their way through the supply chain and ultimately result in higher prices for buyers. Locking in current rates is always a good strategy to use when prices are expected to rise, but I think given the already enacted steel and aluminum tariffs and threats of trade wars, buyers really should be taking this proactive step to lock in rates now since costs seem poised to rise given the volatility. Braden, let's switch gears. What's going on with trade policy? Steel and aluminum tariffs really are just the tip of the iceberg when it comes to the changes happening with trade, aren't they?
Yes. So the steel and aluminum tariffs are only one part of the recent escalation of the quote-unquote trade war. So just for some context, the trade war traces back about a year ago when the Trump administration levied tariffs on imports of softwood lumber from Canada. And then this was followed shortly after by tariffs on washing machines and solar panels. To clear up any confusion for any of our listeners, we'll define what a tariff is. A tariff is a tax on an imported good, and really the idea is to protect domestic industries from foreign competitors.
And like with all taxes, I'm guessing foreign producers simply pass the expense on to buyers?
Yeah, that's right. Foreign producers rarely absorb these taxes on their own, so they end up passing these added costs onto buyers in the form of higher prices. So what happens is buyers substitute foreign goods for relatively cheaper domestic goods, which then gives domestic operators more pricing power. So for example, washing machine prices in the US have grown a little over 15% since February, which is actually the fastest it's ever grown since the BLS started collecting this data in 1978. So really the main idea is that no matter how you slice it, US buyers end up paying more when there's tariffs involved.
Okay, so we know we'll all be paying more. I think as a consumer myself, I would think most other consumers want to know just how much more. What factors are going to determine that?
So it's really going to depend on the cost of the good. So let's think about a can of soda, for example. Tariff on aluminum would raise the cost of a soda by a really small amount, like talking mere cents here. Now, contrast that amount with an automobile, which uses a lot more steel and aluminum inputs. That can translate into hundreds or even thousands of dollars in additional costs for manufacturers, which would raise costs significantly for buyers of those goods.
So beyond steel and aluminum, there's been a lot of talk about the Trump administration's decision to levy tariffs on Chinese imports. I want to get into specifics here. Torsten, what's the total value of goods impacted, and what are some specific examples of impacted products?
So the new tariffs impact a large number of goods from China. So far, tariffs have been placed on $50 billion worth of goods, and even more goods are going to be subject to tariffs pretty soon. In fact, a 10% tariff on an additional $200 billion worth of Chinese imports is going to be enacted on September 24th. And then this tariff is scheduled to increase to 25% on January 1st. So overall, we're looking at tariffs on $250 billion worth of Chinese goods by the end of this month. If we look at the pie chart here, we can actually see a breakdown of the goods that are affected by tariffs as of August, and we've classified them by their HS codes. And just looking at the list, you can see that the tariffs enacted are affecting both finished goods and intermediate goods.
And to make sure our listeners understand, can you describe the difference between a finished and intermediate good?
Sure. So a finished good is a completed product, like a piece of manufacturing machinery, and an intermediate good is a product that's used as an input to make finished goods. So a lot of the finished goods that have been impacted by the tariffs are used in various manufacturing processes. So this can affect the price of other goods and services throughout the U.S. economy. And a good example here is, let's look at a variety of metalworking machines are now subject to tariffs. And any manufacturers that rely on this equipment to produce goods will potentially face higher operating costs, especially if they expand their operations or need to replace any aging equipment with imports from China. They're going to pass these costs on to buyers in the form of higher prices. So we should also consider how more expensive manufacturing equipment can affect other parts of company supply chains. And let's just look at corrugated boxes or paper bags as an example, since the machinery used to produce them is also subject to the new tariffs. If you rely on corrugated boxes or paper bags to package your own products, and the machinery used to make them has suddenly jumped in price, then you can expect that your expenditures on purchases are going to increase.
So you've been touching a lot on production machinery. What other kinds of products are going to be affected, though?
Mm-hmm. Yeah, it's not just manufacturing equipment that's actually being impacted. So after next week, we're going to be seeing new tariffs on other finished goods like network routers, which have otherwise been trending downward in price during the past 3 years. It's really an extensive list of products that are being affected.
And how about intermediate goods? What specific products will be impacted there?
Mm-hmm. So the same logic applies to many of the intermediate goods that have been impacted by the tariffs. So, for example, some varieties of plastic film are now subject to tariffs, and as a result, products like flexible packaging and plastic bags, which are made from this film, could potentially increase in price at a faster rate in the coming years. So as manufacturers pay more for these inputs, they'll try to protect their profit margins by raising prices. And this increase in cost will affect not only those manufacturers, but also any downstream markets that rely on domestically produced plastic products.
Braden, let's have you jump in here. We know, as Torsten just said, the tariffs are going to raise the cost of finished and intermediate goods. What about the cost of procuring services? Is there going to be any impact there?
Yeah, that's a really good point because we often don't consider how service providers can be negatively affected by tariffs on goods. So we believe services that rely on heavy machinery and other capital goods will be the most impacted by these tariffs. One example that sticks out to me is managed print services, because at face value, this doesn't really seem like a market that would be impacted by tariffs. However, a lot of providers offer on-site printer repair. We actually estimate the average vendor spends almost 10% of their revenue on replacement printer parts, many of which are now subject to tariffs. An analogous situation can be seen with markets like truck maintenance and repair, which also rely on automotive parts to provide services. So as the cost of these parts go up, these service providers will charge more for services to protect their profit margins. And this market is a particular concern because auto parts may soon be subject to new duties as well. Really, so the unfortunate thing is that professionals in indirect procurement often have to deal with these price increases.
So what are procurement professionals to do about this? What strategies have you found companies using to identify the impact of tariffs and respond?
Mm-hmm. So the first thing the first strategy that we've found companies using is that they need to actually identify potential risks and determine what aspect of their operations might be affected. So companies can use cost simulation software to model different scenarios and account for how potential supply chain disruptions are going to impact them ahead of time. This strategy is going to be particularly important as more tariffs are enacted. And since the Trump administration is enacting tariffs on another $200 billion in imports next week, the risk that your supply chains will be impacted in some way is fairly high. I should say, though, that this strategy won't entirely mitigate the impact of the tariffs, particularly if your expenses are rising because service providers are facing new operating costs, but it can at least help companies evaluate the potential costs that they'll face.
Okay, and that seems like a good long-term strategy. And but what can procurement professionals do right now to minimize additional costs? Because I think what you're describing, what if costing, is more of a long-term.
Mm-hmm. Exactly.
long-term strategy. Is there anything they can do right now to respond to these tariffs?
Yeah, absolutely. So buyers can leverage high volume purchases to incentivize providers to offer lower prices. So by increasing the volume of purchases, companies can often negotiate per unit price discounts, which can help them overcome some of the increased costs associated with the new tariffs. Now, of course, for this strategy to work, the company would need to be able to purchase sufficient volume. So as a result, it's really not a viable option for everybody.
So I'd like to expand on what Braden said, because buyers can also negotiate long-term contracts to establish fixed prices. And this is actually the same strategy that you can use to deal with rising commodity prices like we discussed with steel, aluminum, and oil. If you know that your operations rely on consistent levels of certain inputs, such as the intermediate goods impacted by tariffs, you can forecast out your needs and negotiate appropriately to lock in prices. And once again, this is going to be particularly important if your supply chain has any exposure to goods that might be subject to further tariffs.
So with these tariffs, what I'm hearing is that China seems to be the major target right now. Are there, Braden, I want to have you kind of jump in here again. Are there opportunities here to source from other countries?
Yeah, so the final option is for buyers to source purchases from countries with more favorable trade agreements. So for example, it may be worthwhile to consider alternative trading partners that are actually exempt from tariffs altogether. So if we're looking at something like steel inputs, currently Argentina, Australia, Brazil, and South Korea are all exempt from steel duties. Keep in mind, though, that these countries may not have the volume to satisfy demand. So for example, Australia accounts for less than 1% of steel imports in the United States. With regards to the goods impacted by the tariffs on China, I'd like to add that there are several other countries from which to source these goods. If we look at the types of plastic film impacted by the tariffs, for example, this material can also be sourced from countries like Canada, Japan, and Germany. Although this final strategy might involve more work to identify alternative suppliers, it could result in significant cost savings for some companies.
Overall, it sounds like there's no one-size-fits-all strategy for adjusting to the China tariffs. Rather, there's a variety of strategies that procurement professionals can use. We put a lot on the table here, and because the situation with tariffs is really fluid, I just want to wrap this discussion up with a few takeaways. So what we've discussed, there are already tariffs in place on $50 billion worth of Chinese imports. That figure is going to rise to $250 billion when additional tariffs go into effect next week. With these duties, the cost of sourcing inputs for manufacturers will rise, and that's going to increase prices for buyers down the supply chain. And as Braden, you pointed out, services won't be shielded from these price increases either, because the cost of those input materials that are associated with those services is also going to rise. Did I kind of capture all that? Is there anything else that you wanted to add?
Yeah, it's a good summary, but I think the biggest takeaway from our discussion of the tariffs is that it pays to be proactive rather than being reactive in this case. Pretty much everything coming from China is going to be taxed, is what we're looking at, and often these tariffs are being placed with relatively little notice. So you have to make sure you understand your exposure to them, how they're going to impact you, and what you can do to prepare, rather than waiting to see what the effect is going to be after they're already in place.
Okay. I think that that does it for our two sections. We have some time for questions, so I wanted to see if we could get to some. The first one I'm seeing is there has been a lot of news lately on the renegotiation of NAFTA. Can you comment on the new deal? Who wants to take that one?
I'll take that one. So the new NAFTA deal is actually currently still under negotiation. And the U.S. and Mexico reached a preliminary bilateral deal, but negotiations with Canada are actually still underway. And so because the deal is still in the works, we'll actually be focusing on it more in future updates, because we want to ensure that we're providing our clients with up-to-date information and how these changes are actually going to ultimately impact them. So, we're kind of waiting, like everyone else, to know what shape that's ultimately going to take.
Yeah, and I really think that speaks to how fluid the situation really is. That question does. Second question, China announced that they're going to retaliate by imposing duties on U.S. goods. Is this going to have an impact on sourcing domestically? Braden?
Yeah, so it is true that China is placing tariffs on U.S. imports next week. I believe it's going to go into effect on the 24th. Is that right, Torsten?
Yeah, 24th.
And I believe it's going to hit something like 5,200 U.S. products. However, we don't expect that these tariffs are going to actually have a significant impact on procurement professionals here. The tariffs China's enacting are going to hit exports from the U.S., so while this may impact your company's profitability, the price you're actually paying for these goods won't be affected.
Okay. And looks like, can you comment on the drop in the PPI that occurred in August? And just for our listeners, the PPI, Producer Price Index, what that stands for.
Yeah, this the PPI has dropped for the first time since February 2017, and the cause of this drop was that there was a decline in the price of food and trade services. But even though it was a relatively minor drop because the cost of energy products and healthcare services was still inching upward. And so for more detailed information on what these price changes are actually going to mean, you can actually look at the reports that we prepare on over 1,000 different categories, because we'll go into detail in those about recent price trends and price forecasting based on the PPI information and other data points. So really, if you want to know what the effect of that PPI drop is going to be, we direct you to our research on different categories.
It looks like there's a lot of questions coming in. We're not going to be able to get to all of them, but I wanted to emphasize that we are going to be following up via email with any questions we weren't able to get to today. So I want to thank both Torsten and Braden for joining us on today's webinar. I hope that our listeners found it helpful and that we gave you some key actionable takeaways. As a reminder, we also recorded this presentation and we'll be sending out the link in the next day or two. And again, look for that personal follow-up email for your question if we weren't able to get to you today. And thanks again. Thanks to both of you for being here.
Thank you for moderating, Sean.
Thank you.